Hello, welcome everyone. Today we're going to have another mini workshop that is an initiative of the GTC network, which is a network for independent tax litigators. And today we have Hans van den Hurk, Louan Verdoner and Steef Huibregtse, and they're going to have a panel discussion on Pillar 1 and Pillar 2. And I'm going to give the floor to Louan with the first question. So Louan, what did BEPS 2016 do in terms of changes?
Yeah, many changes, I think. BEPS, the reports of 2015 and also the developments after that are very at an enormous impact on the tax society and society in general. There's a lot of topics to be touched, amongst others, tax leakage, transfer pricing, value creation, deduct limit on deductible interest. It is the nexus. It is just the tax treaty, improper use of tax treaties. So you can mention everything, and it is just a sort of fear of flying from the governments that they estimate to have lost grip on taxable events or possible taxable events. It should be taxed, but cannot be taxed anymore based on a lot of developments. Amongst other, the digital economy, that was action on one. There was a big report which was not received positively in all gremiums, but anyway, it was the starting point. And that's also the one who is important now in connection with the Pillar 1 and Pillar 2, especially with Pillar 1. And also other aspects which came in, the development of the big tech giants who are threatening to govern the world. And yesterday I heard a broadcasting for someone who said, yeah, it is the tech giants in comparison, and together with a sort of new Stalin will govern the world within a certain time period, because they can know everything from everybody, and therefore a new tyrant has the possibility with technology to govern the world. But that's outside of the tax aspect. And going further on the tax, yeah, I wonder whether we are on the right path, because in principle you can say that there is a certain tax leakage which is unacceptable. That is based on the Paradise Papers and the Panama Papers, in which prominent persons have tried to escape taxation, which normally should be due by just hiding their major part of their wealth in shady regions, and that's a sort of extreme. But at the other side, the big attack is unto the big corporates now. The big corporates, they are paying too less, not enough tax, because they already pay it in an outside country or in other countries. And they attacked, for instance, Shell company in the Netherlands because they should not pay tax. At least not in the Netherlands, but that's a Dutch perspective. That's a part of it. But also in general. And then I wonder whether this is right. And then you're coming to the philosophical background. So the tax principles underlying levying tax, which is done in Pillar 1 especially, but also the Pillar 2 and the minimum alternative tax is part of it, part of this kind of thinking. And so what is the tax principle which is underlying the right from the tech companies over the territorial jurisdictions to levy based on value creation in market conditions based on Pillar 1? Is that an ability to pay? Is that a benefit principle? Yes, it is a benefit principle, because the tech big giants benefit from the fact that they can sell their products through a digital channel in a lot of countries, a lot of jurisdictions outside of the United States and China, and therefore this is a reason for being taxed over there. Well, you can discuss whether this is true because yes, benefit principle has acted in the context of, for instance, source taxation. Source taxation, withholding tax taxation, is based on the fact that a company has a permanent establishment or otherwise benefits from the existence in a certain countries and from the environment, good employees, stable currency, economic climate is good because it is really established in that country. But in this case, there is you can only speak about a certain artificial or not artificial value creation by having a market in which products can be sold. And I wonder whether this is, and then I'm just thinking back to the 20s, the League of Nations and the basis of taxation. Then they said, yes, a fixed establishment is the basis of taxation anywhere, and a fixed establishment was the first part to be taxed, and therefore it went further and further. And now I think this is a sort of fluid, kind of value creation. But you need users there, you need distributors. But the distributor is not important anymore because it's a right away B2C sale. So the distributor, the B2B, is not important anymore. There's a baseline remuneration that's out of scope here for the so-called amount A, and that's a kind of arbitrary, the deemed part of compound A. How to come to that? How to have the scope and also the threshold? That comes to me as a rather arbitrary point. And if I go to the United States, which I'm rounding off up by Mr. Mnuchin, who said, well, we will apply the safe harbor. Well, then that's the first conflict between in the tax certainty atmosphere between two countries, between the United States against the rest of the world, which is now also the fact with Mr. Trump in the office, with the United States against the tax, but then in the tax field. And that's because it is the safe harbor rule against the amount A attribution, reallocation of the remainder of the countries. So how to solve that? I think that's asking for difficulties. Let me finish here for the moment being.
Okay, yes, thank you, Louan, very much. Now I would have a following question for Steef. What are the economic reasons for a new version of fair share referred to as Pillar 1 and Pillar 2 blueprints?
Thanks, Anna. The essence is here, if we look at the final reports of BEPS in 2015, they basically took the road of where people are active, that's where the profit should be reported. They did not, as Louan already indicated in the beginning, they did not find a good compromise for the tech giants who hardly have any, if any, local presence in terms of people. So if you are not physically present in local countries and you are becoming a big tech giant that allows you to bring all the profits home and being allocated to the home territory. As a consequence of BEPS, the profit allocation will be moved in favor of the home territory of that tech giant. As a consequence, a lot of countries around the world will have a leakage in their treasury budget, simply because they can't levy, because the tech giant doesn't have a physical presence, or at least a sufficient nexus to tax them on their profits. Yet there is what I call a digital ecosystem on the ground in each market jurisdiction, which does allow this tech giant to run excessive profits from. So the combination of a tech giant like Google and Facebook requires local users, local buyers, internet service providers, server parks, and there's about 7 local actors. If these local actors would not be present in those territories, it would not allow the tech giants to create those excessive profits. So the economic reasons are that there is something which is called the M&Es performs, say, 7 functions, but there's also these 7 local actors which perform functions complementary to the value chain of the multinational. And as a consequence, if you take that into account, allows the tech giants to make this excessive profits. You could then economically argue that some of those profits are indeed co-generated by this digital ecosystem of local actors. That's the economic base for saying, okay, a portion of the profit reported in the home territories of the tech giants it should be reallocated to the market jurisdiction where all these local actors are. If you do that, the OECD in Pillar 1 in the blueprint just published last week has said, okay, if you look at the typical multinationals who make more than 8% operating margin, then there's about 1,000 multinationals worldwide. If you say that any profit in excess of 10% is being tracked as the to be reallocated profit base, then you get to 500 billion based on about 1,000 companies looking at their CBCR, their country by country reporting. If you say of that 500 billion profits to be reallocated, 20% should go to the market jurisdiction where those local actors are hiding. You get to the $1 billion they actually are highlighting in the Financial Times and in other newspapers last week or 2 weeks ago. So they assume of the excessive profits, 20% roughly, say in the range of 10 to 30%, should be reallocated, not based on the BEPS rules, but on the BEPS rules plus a political choice to bring some money back to the market jurisdiction where that digital ecosystem is indeed creating a value. It does breach and go beyond the boundaries of Article 9 model treaty. So you need to have a dialogue. Are we going to change the arm's length principle? Can that be applied between also non-associated enterprises? That's a question. Or should you come up with a new Article 9 to deal with this reallocation, to be reallocated version? If you don't get to compromise, you're in trouble because you will allow the BEPS 15 rules to rule the waves, which has a lot of leakages, and a lot of governments will be underwater soon if that trend is going to continue. So that there's a sense of urgency, and the big question is, are we going for an economically valid reallocation of profits, or are we taking a political stance, which is a little bit more what Pillar 1 is doing?
Okay, thank you very much. Now I would like to ask Hans, what, in your opinion, is the legal base for Pillar 1 and 2?
That's a simple one. There is no legal base. But going back to the background, the point is, of course, that the old system, as Louan mentioned, the League of Nations system, 1923, I believe it was, from that moment on, countries started to make agreements on how to deal with double taxation. And you have to take into account that I remember it was in 2014, I was sharing an OECD G20 tax meeting, part of it, and asked in that meeting, Pascal Saint-Amand, what do you think was going to happen with BEPS actions? And he said, well, he said, probably you believe that we're not going to be that successful, but at least we changed something. Well, now it's 2020, and we know that they changed a lot of things. So they were quite successful. So they took the momentum to try to get the world in the next phase. And that next phase is pillar 1, pillar 2. And the point is, if you want to change the system, principally, yeah, you need to have the support of all the relevant states of the world, because otherwise you're going to be in, as Steve mentioned, deep trouble. And assumingly there will be deep trouble, because some states tend to believe that their own system, like India, for example, already has a digital taxation kind of a system in place, is much beneficial than the pillar 1 system. So why would they accept a new system? And many states, the loser states in a way, like the US, because they have to give away the revenues to other states, they have these discussions on pillar 1 of Mount A and B, and those kind of discussions. It's going to be tough. It's going to be tough. But I still tend to believe that one way or another there will be a solution, because this is really what the world nowadays needs, a reshift of balancing acts with respect to taxation. But it will take some more time, and it's not going to be perfect, really not going to be perfect, but still, yeah, it is what the world wants. So, yeah, one way or the other, it will be achieved. And back to the legal basis, because there is no, it's not a regulation or a directive that has to be implemented in all states. It's nothing. It's just states which support the ideas. And in the end, always can say, I don't agree, or just in the negotiations with other states, if they don't find a multilateral solution, in the negotiations with other states, they reject. So no legal basis, a lot of problems to expect, but there will be a next step, I assume.
All right. Then I would like to ask Steve, how effective is this pillar 1 then?
Well, that is kind of doubtful if most of the multinationals who have this excessive profit in their books are, especially in a consumer-facing business or in a digital industry where they tie their service platform to citizens. It's kind of a difficult game. I think I understand the tax policy logic. Countries are kind of panicking because suddenly the whole balance out of the system is gone away because of this monopolist behavior by certain actors. The US government has just issued a 447 pager where they address the market power by Apple, Google, and Facebook and Amazon. And basically, if you take that as a starting point, that some of these tech giants do actually have a monopolist power, there's two things which happen on the effectiveness of pillar 1. One is there was an article in Financial Times where Google already said, okay, someone taxes me 100 million more, I'm a monopolist, so I will work that into the prices for my goods and my services. So de facto, it means the citizens are going to pay for it. And although the OECD still believes in actor terms that tax policy will be organized and orchestrated by them, the only way they can control the prices of the services by Google is if they would make the services of Google being subject to the postal regulatory framework in a country where, well, like the postal US services are under a predefined price level by the government. But so far, Google is free to drive its own prices. Another thing is where the to be reallocated residual profit falls flat is when you allocate this profit to the jurisdictions. You can make a difference that you say, okay, in certain industries we make more money, in certain business lines we make more money than in others. Maybe Amazon makes most money in their logistics services and not so they're selling books, selling pharma, selling vegetables. Well, obviously that's a functional allocation. So if Amazon comes up with a functional allocation, maybe that to be reallocated portion does not really move a lot of profit out of the US to other territories. And I even have a worst case scenario. If I look at Facebook, Facebook is probably making, this is rough cut, but you can calculate the numbers, is making $30 of gross revenue from non-US Facebook holders. And it's making about $2,000 gross revenue from US-based Facebook holders. Well, if you say, well, most of the to be reallocated residual should go back to where the money is being generated, then in this particular case, the money is not actually leaving the US as Hans just mentioned, but it's injected right into the US simply because of this geographical segmentation the OECD is promoting. So effectiveness with monopolists, I have my doubts.
Thank you, Steve. So Hans, one last question for you. In the face of this complexity, how should companies deal with upcoming disputes?
This is the main reason why there are two things why Pillar 1, for example, doesn't fly yet. First of all, of course, the system as promoted, which gives winner and loser states, more or less. But the second one is the dispute resolution system. Many states, including, for example, the US, but also the Netherlands, they demand a mandatory dispute resolution, which should be interpreted in such a way that whenever there's discussion between states, be any double taxation left after that dispute arose. And here you see that this is for many states an infringement on the sovereignty. They feel it as an infringement on the sovereignty. They don't want, because you can have a dispute via a court case, but mediation, arbitration is also possible. Arbitration is probably the best way forward. And arbitration is being considered to be infringing on the sovereignty of the state, since somebody not from the state is going to decide what comes up to that state. And this is the main issue. And my only fear is that in the end there will be a compromise which is acceptable to a lot of states, but which doesn't include a good and solid mandatory dispute resolution. And keep in mind that even within the European Union, there is this mandatory, this dispute arbitration directive. An arbitration directive doesn't safeguard a company against all dispute risks. Some qualifications, for example, are excluded. So what it meant to say is, in the end, most states tend as if they like mandatory dispute resolution, but in the end, many states, specifically India, also the African states, but also some European states, just don't want an arbitration system to be in place. And as a consequence, disputes will be a major issue in the future.
Yeah, Hans, just a nice addition to that. We've been studying the Vodafone case in India, where obviously, as you rightfully said, India is not very cooperative on arbitrage of any kind in that sense. And in that Vodafone case, obviously the Supreme Court said to the India tax authorities, well, you know, you can't tax this profit made on Vodafone business, but they changed the law with retrospective effect, the government, and subsequently now I think there was a verdict 1 or 2 weeks ago where Vodafone went under the investment treaty to the court in The Hague and asked for a verdict where the court in The Hague basically strongly recommended in India to step back with its taxing rights, especially the retrospective nature of those taxing rights. So, you know, then suddenly you escalate from an unwillingness, an unavailable arbitrage for taxpayers, you escalate to a investment treaty which has a higher ranking. But yeah, that's the consequence of the position that you don't want an arbitrage or an arbitration clause in the treaties or in the application of the MLIs.
The bad thing about bilateral investment treaties is that the United Nations is working on a revision of those treaties because they are being used in situations which they don't want them to be used.
Exactly.
You probably gave an example of such a case. So in the end, we are looking forward to a difficult era with all kinds of issues. I'm not optimistic about
exactly. That. But when we 5 years ago, Hans, when you and me had this discussion, we said, well, investment treaties exclude tax because that's handled in the tax treaties. I think the world in terms of litigation has materially changed as we see today with the Vodafone case.
Yeah, yeah.
All right. Thank you all for participating. This was very interesting. My questions are over. Certainly a lot of food for thought. Again, thank you for participating and enjoy the rest of your day. And most importantly, stay safe.
Thanks
very much.
Thanks.
Bye.